and welcome to a brand new show of Market Makers. We are at the current juncture where perhaps we can debate, argue and deliberate that is the worst of the print behind us, or what we've seen in the month of July is more like a relief and a sharp bear market rally. Thankfully for us, crude is down, but unfortunately for us, valuations really have not come back to levels from which market bottoms have been made. My guest on the show today is someone I've admired over the years for his ability to find individual stocks, and we've got into a lot of engaging conversations which our viewers have enjoyed. One terminology which I've learned from him is to buy fallen angels. Where are the fallen angels in this market? It gives me great pleasure to welcome on board the one and only Hiren Ved of Alchemy. So nice to have you back. Let's do a high five. We're meeting after 2 years.
Thank you so much. Thanks, Nikunj. Great to see you.
Likewise.
It's been a long time.
Feels so nice to meet you in person and talk about markets in general to understand how things are.
Yeah.
How are you holding up? And how are portfolios holding up?
Portfolios are doing very well. I think last 2 years can't complain. I think we've done phenomenally well. Many of our big calls have gone very right. I think our investors are quite happy. So
the template has changed. 2020 there was a tailwind called low interest rates and low commodity prices. Now the challenge is rising interest rates and high commodity prices, which means the template of investing has changed completely. How are you dealing with this?
So Nikunj, I think if you look at interest rates in India, right, I think that the corporate sector is pretty much deleveraged, right? So I don't think that, unlike in the previous cycles where the corporate sector was significantly leveraged, rising interest rates posed a very big problem to companies. Having said that, anyways, in terms of our philosophy, we don't buy into companies which have too much leverage, right? Or even if we are buying into companies which have leverage, we are very confident that over the next 12, 24 months, the leverage is going to come down very significantly. So I think rising rates, then the only question is that will demand get dampened because of rising rates in interest rate sensitive sectors like automotive or housing or so on and so forth. And I think that rates have increased, but I don't think they've increased to a point where it would deter demand, right? We've not seen data from real estate companies to say that, you know what, my bookings have gone down or my pre-sales have gone down because interest rates have gone up. In fact, if you look at the commentary of HDFC, they've dispersed the highest amount of retail housing loans that they've ever done in their history, right? A lot of the real estate companies have given Q1 updates and they don't seem to see any slowdown in real estate. Let's look at another interest rate sensitive sector like automotive, right? Yes, two-wheeler demand has been struggling. We've not yet reached pre-pandemic levels. And a lot of that has to do with the fact that demand destruction happened at the bottom of the pyramid. The people at the lower end have seen their incomes get shrunk during the last 2 years of COVID period, but that's coming back. And also because of raw material price hike, two-wheeler prices went up dramatically.
Yeah.
But if you look at four-wheelers, right, and in four-wheelers definitely almost now majority of the cars are sold on financing, but you still have long waiting lists for the right kind of model, right? So I think that...
Have you bought a new car post-COVID?
Yes, I did. But I had to wait 6 months for that, right? And the beauty is that under the garb of chip shortage, right, today car companies are able to charge virtually a premium.
There's no
it's
discount.
Like take it or leave it.
There's no
right?
discount.
There is no concept of discounts anymore, right? In fact, it's very interesting when you look at the EBITDA margins. We would have thought that with steel prices going up, with raw material prices going up, EBITDA margins would shrink. But automotive companies have been able to hold or better their EBITDA margins because they got pricing power suddenly. Demand is more than supply. This has not happened in a long, long time, right? So my view is that I don't think interest rates have gone up that dramatically in India, which would deter demand. Also, I think this year we are seeing the benefit of revenge consumption sort of coming back. People are beginning to travel. I mean, air tickets are 2x or more, and still you have people traveling very, very aggressively, right? So I think that in my view, the template hasn't really changed that much. Now, is commodity prices going up a challenge? I think we clearly saw that in margins of many companies, that because of energy prices, because of power prices, because of raw material prices, there was a softening in the margins that we saw. And we continue to see some of that. But I don't think it's going to derail the big earnings recovery story in India. I think one reason why, in my view, beyond talking liquidity, the markets have held up so well in India is because after a long time, earnings growth is looking real. It's not like every year we start with 15% and end up 4%, right? So in in a COVID year, earnings were up 18%. The next year, which is 21-22, the March that just got over, earnings were up 37-38%. On top of these 2 years of earnings growth, we were talking about a 17-18% earnings growth, which may probably settle at 14% because some cuts will come in commodities and metals and energy and stuff like that, right? But I think overall, the earnings picture looks to be much better in India this time.
So we've got the black and white sketch from you. Let's start filling in the colors. You flagged off autos. Let's start dividing the auto into 2 or 3 large parts. One is you've got Tata Motors and Mahindra on one side, which already have got commitments in the EV business. Maruti, some would say a late starter, but they are not doing anything in EV. Four-wheelers, how things stacked up according to you? Go for the EV guys or don't go for the EV guys?
So I think, in the four-wheelers, there are 2 trends which are very important, right? One is that very clearly the market shifting to SUVs. And secondly, obviously EV is picking up, but it's still a very young trend. But you got to, if you believe, and I do believe that, EV penetration will move up dramatically, then you have to be positioned with companies that are ahead in the game. And there, very clearly, Tata Motors is ahead in the game.
Are you not worried about JLR, China? Tata Motor also has this global overhang now.
That's the problem. I agree with you that it's not such a straightforward story, right? If Tata Motors was only Tata Motors,
The domestic
India,
business, yeah.
the commercial vehicles, which is in a sweet spot, and the passenger vehicle business, of which they've done a fabulous job, I wouldn't have thought so much. But the JLR business, though, that's doing well, that brings in a lot of volatility. And typically in an environment like this, where you have global macro uncertainties, there is an energy crisis in Europe, you are not very sure whether you will get the kind of turnaround that we expect in a JLR, right? So we did invest in Tata Motors, but unfortunately when the war broke out, we thought that it would cause too much volatility in the portfolio, given the uncertainties around what's happening in Europe and what's happening in China. But if that settles down, I do think that Tata Motors is a great play in my view. And then obviously now M&M seems to have got finally the models right. They were losing their edge in what they were good at, which is SUVs. The Koreans had come and taken away a large part of the market share. I think the recent products have been very good. The feedback has been very good. And therefore, I think that, the four-wheeler story remains to be reasonably strong in India.
How have you used the downturn to your advantage? On an average, the small cap correction is about 35%.
Yeah.
On an average, the mid cap correction is 30%. A lot of stocks have sold off not because they deserve to go down, because there are compulsions. FI selling, HNI selling, PMS selling. How are you using the downturn to your advantage?
So I think, Nikunj, we run a multi-cap strategy, right? And we've always run a multi-cap strategy. And we understand that there are cycles within markets where sometimes there is a risk-off environment and markets get sold off. I think we are very clear that we've used these downturns to add to positions where we think that the risk reward is fairly favorable. We don't get deterred by the fact that stocks have fallen 25-30% as long as we believe that the long-term structural growth story is pretty much intact. But I must also say that many of our mid caps have actually done very well.
Give me an example.
Right? For example, Tata Alchemy, which is a reasonably large holding for us. I mean, that stock hasn't corrected at all. In fact, it's outperformed every other tech stock, right? While most of the tech stocks recently have taken a beating, and for that matter, we also own LTTS, but LTT has corrected very dramatically, 40% plus. LTI has corrected, but Tata Alchemy hasn't, right? So I think that the ability to identify every couple of years a couple of stocks that we believe are in such a strong structural tailwind has helped us quite a bit.
So
right?
let's say if it was Bajaj Finance between 2010 to 2015, it's Tata Alchemy between 2018 and 2022.
Exactly.
Markets are forward-looking, sir. What happens between 2020 to 2025 is what we need to understand. See, I understand and I respect the fact that over the years I've learned that when you're investing, you are investing in an uncertain future.
Yeah.
Nobody has complete information.
Yes.
But you work with probability.
Yes.
Where are you working with high conviction and a probability that you will get a company or a stock which could compound at 25 to 30% for next 2-3 years? Where are you picking that spot? Which are those names?
So Nikunj, I mean, you never know on day one when you're investing. When I invested in Bajaj Finance in 2010, I didn't know that it will compound at 40%, not 25%.
It was what, at 90 rupees?
It was at a market cap of 1450 crores.
Wow.
Okay,
1400 crores.
Yeah, 1400 crore market cap, right? And we still own it, right? So, similarly, when we first invested in Tata Alchemy in 2016-17, right? The market cap was like hardly 2,500-3,000 crores. Now it's 60,000 crores, right? So you don't know, and it did nothing for the first 3-4 years. In fact, twice it corrected 40%, right? But the real inflection point came post-COVID, right? Where it went from the lows of 500 to now 8,000 odd rupees.
Hard to imagine, but it's actually happened in 2 years.
It's actually happened. Right?
2 years, 500 going
yeah, but
to
it takes,
7,000.
Sometimes, you know that the right ingredients are there, but you never know the timing or the inflection point. You can't time that.
Great point.
So you have to be invested, and you have to have the conviction to stay invested in those companies. So if you ask me, where do I see opportunities? I think, in my view, there are a few candidates. For example, Varun Beverages has done phenomenally well for us, right?
You've been owning it from the IPO, I think.
Yeah, I mean, a little bit, post it went IPO, right? I mean, it's a great business. The way they have been able to generate cash and deleverage the balance sheet, and very disciplined capital allocation, and very strategically and systematically adding market share in Pepsi, almost reached 90% market share within Pepsi in India. And now many more products, on the same distribution network or
But
highway.
won't it be a B2B business? Because there's no upside for you. Ultimately, you are doing what is called as contract manufacturing.
Well, I think it's not just, there is a little bit of a myth around VBL that it's not a B2C business but a B2A. No. I think it's a clear it's a B2C business, right? It's a B2B, B2C business, right? How you penetrate distribution, how you go about marketing is very, very important, right? But I would say that, there are a lot of young businesses, again, which to me are looking promising, right? In one of our AIFs, which we call Alchemy Leaders of Tomorrow, where the idea is to look forward, not look at leaders of yesterday or today, right? But
So you will not buy a Bajaj Finance or Asian Paints or Infosys in this scheme?
yeah, I mean, we have Bajaj Finance because we still believe that, there are few companies which are still in that leadership mode, right? But yes, the idea is that not Infosys won't make the cut, but a Tata Elxsi could make a cut there, a Persistent could make a cut there, right? So very clearly we are seeing that because, the landscape changes, new growth drivers come in, and new young entrepreneurs come and do things differently. So for example, during the pandemic, one of the big things that happened was people sitting at home and trading, right? You see so many demat accounts being opened, you had these digital platforms which allowed you to trade, and then you had the likes of ICICI Direct, which is ICICI Securities, and Angel One, and Zerodha, and a lot of these guys who came in. And when we looked at that space, initially we thought that the two horses that we could look at is ICICI Securities and Angel One. But to us now it looks like that Angel One has probably done a better job at creating a fantastic tech platform, right? And this is when you had many traditional brokers who also had online presence. I mean, you have Motilal who has online presence, you had Kotak Securities who had online presence.
The Dadas.
You had HDFC which also has an online presence. But I think two companies who really transformed themselves were ICICI and Angel. And I think Angel is a little bit ahead when it comes to being a pure play tech platform, right? I think, so for example, we have taken a bet in our Alchemy Leaders of Tomorrow where we think that and in the recent months, their customer acquisition was even ahead of Zerodha.
Yes.
Right. So I think there are a lot of young entrepreneurs, young businesses that are coming in, which may grow dramatically. For example, we did participate in the IPO of Ethos. We already owned KDDL earlier. I mean, it's a company which is not very well known.
Yes.
But like what Titan did to the jewelry business, can Ethos do to the luxury watch business, right? And I think very early days, but I think they're going about it, very, very systematically. They have stores, but they also have ethoswatches.com, and they source 30-35% of their watch sales online. Who thought people would buy expensive watches online? But that's happening now, right? And there are very few people who have an organized format to be able to capture that market, because now there is a larger consumer base which can afford to buy in India. It's no longer कि मैं Dubai जाऊंगा and I'll buy a watch,
Indians
or
are
I'll go to
getting
the
richer.
US, or I'll
Indians
go to
are
Europe and buy a watch. You can buy the same thing here.
And the price arbitrage is not there.
And the price arbitrage is not there, and especially after GST and demon, cash transactions, and the unorganized market has kind of gone away and the new market has come down. Then there was this whole debate over the last few months about a commodity super cycle.
Yes.
And we were thinking, how do you play that, right? So first of all, you looked at the arguments that yes, there has been huge underinvestment in physical resources and commodities. We are seeing a geopolitical problem which is causing even more supply chain problems around the world. And we were thinking, how do you play this, right? So obviously the most clean way is you go and buy a Hindalco or a Tata Steel or whatever.
You bought into steel?
We did buy into
still
Tata
own
Steel.
steel?
We don't now.
You don't?
We exited,
Okay.
right? Because it's too volatile, right? So, but we made money. We made money in Hindalco. We made money in Tata Steel. But then we realized that a great way to play the resources boom is probably through a high quality manufacturing company like AIA Engineering.
That's your all-time favorite.
Yeah, I mean we've liked
Wounded
it,
in
but
the
then
past.
in between the company went through a lot of growth companies do go through phases where nothing happens for a while. But I think that inflection point is coming back where volumes are likely to rise. They are almost global number one market share or number two. They have a great business, right? 22, 23% EBITDA margins, 22% plus ROE. And now I think the cycle is in their favor. So you want to play mining, you want to play resources, you want to play cement. Probably a better way to play that is through a company like AI.
But you won't buy cement. I'm looking at the data points here. Big consolidation in the sector, entry of a large player. The existing largest player, Ultratech, is looking at expanding capacity. Efficiencies are kicking in. Won't you just bet on cement? Just bet on that commodity.
Yeah, I mean, the two are independent, right? I'm not saying that because I bet on AI, I won't bet on cement. Though I do believe that in cement, with the kind of price rise we saw in coal and coking coal and coke, etc. I mean, the industry is definitely more consolidated, and I think you have a new player who has come in, but I don't think that's going to change the pricing dynamics, because I think those days are over where you underprice and get market share. I don't think that's going to happen.
A geo moment will not happen.
I don't think that will happen in cement. But I think that the point I was trying to make with AI was that was you look at a long-term trend and you say, how can you play it with a very high quality business and still make money and don't take the volatility of end commodity prices that you would typically end up when you buy a Tisco or a Hindalco or stuff like that, right? So I think there are several young businesses that we are quite bullish on. There was a company we bought several years ago, a great manufacturing company, Sundaram Fasteners, and we bought it several years ago between 60 and 100.
And I'm sure you plan to keep it for several years.
Yeah, and now we are adding again, right? Because the automotive industry went through a very tough period. And despite that, they've done a great job of managing margins. They've now diversified their revenue. They're not just CV focused. They're doing a lot of work in passenger vehicles. They're doing a lot of work in non-automotive. And it's a great manufacturing company, great leadership. We think the next tailwind is coming in companies like that. So I think so to answer your question, and a long answer to your question, I don't know with the next Bajaj Finance or the next Tata Elxsi is, but we've laid our bets on a few of these young businesses which we think can become big over the next few years.
But consciously, would you not buy, let's say, an NTPC or a Coal India or a ONGC, just PSUs, or for that matter, the so-called value stocks? Is there a conscious move not to buy them?
See, Nikunj, what I have realized is that, most of the value stocks are in either sectors or their ownership is something where we have not really experienced consistent wealth creation, right? Now you can buy ONGC for a trade if crude prices are going up. But unfortunately, the problem in a developing country like ours is that whenever prices of resources go up, there is always government intervention, because the government has to take care of people, the last 400 million people population, right? You can't hurt them. And therefore, it's quite logical for them to sometimes intervene. But if you get these kind of interventions, right, you can't have long-term wealth creation in these companies.
Fair point.
So unless you are trading and looking for those short opportunities where you think that you can play a trend, it's great. But more or less, we've seen that it's very, very difficult to consistently make money in a buy and hold kind of strategy in either energy or utilities or PSUs. So we tend to stay away from those, right? And there is enough opportunity in the marketplace to bet elsewhere.
Over the years, what I've realized is that the name and the value of good franchises is something an average Indian is now recognizing. There is a consensus view that Asian Paints is a great company. There is a consensus view that DMart is a fantastically run and managed company. There is a consensus view that Bajaj Finance is a superior business to own. The point is at what price you buy them. The point is that how do you know that if you're buying these great companies, you will continue to make money. Like we've discussed in the past that a great business may not be a good stock.
Yeah.
Where are you getting this combination of good businesses at a decent price?
So I think, Nikunj, you can't put everybody in the same bracket, right? And you have to look at each of these businesses independently. And when you want to, so first of all, you will never get great franchises at deep discount unless the entire market has sold off like 2008 or
COVID
a
sell-off.
COVID sell-off.
That time you don't have the courage to buy.
Yeah, so the thing is that you don't get these franchises at deep discounts. But there are times when you may get these franchises where the premium is lower than what the average premium they're trading at, right? But let's say you gave a great example of Asian Paints. I mean, one of the great franchises which has probably grown year after year after year after year in a phenomenal execution machine. But let's see now what happens with a large entrant like Grasim coming in. It's not to say that Asian Paints cannot fight a Grasim, right? But could you have a lever moment? You know, so there was a period when the regional brands came in, Nirma came in, and you know they gave a lot of competition to a company like Lever. Now Lever is a very strong company.
Patanjali came in.
But you didn't make money for a couple of years, right? So an Asian Paints management could decide tomorrow that I want to sacrifice margins, but I don't want to sacrifice volumes or market share. It may be the right thing to do for the business, but it's quite possible that if they go after volume and market share at the cost of margins, we as investors may not make money for some time until all the competition settles down and the final winner comes back, right? And that period is uncertain. So the only thing that you have to be careful about when you buy companies at premium valuations and these so-called franchises is that you look for disruption. You also should be aware that there is a certain premium for growth that has been built in. The moment the growth tapers off, or if margins go down, or if return on capital gets impacted, then it's not that these stocks will go down to half, but you may just sit and make no money for very long periods of time, or the stocks may just hang around in a range for a very, very long period of time. And that's the differentiation that we have to make, right? So when I look at a Bajaj Finance, I have to understand and ask myself a question: how many high quality, large cap lenders do you have in this country which can grow at 25 to 30% with ROEs in excess of 20%? And the answer is none.
Very few. Who are gaining market share, who don't have NPAs.
Exactly.
And are trying to get technology embedded more.
Exactly.
Very few actually.
So I think the question to each, you mentioned Avenue Supermart. Yeah, I mean obviously the valuations were quite stiff. But if you look at the business, and I asked my team that, you know, there are how many businesses, high quality businesses in India can you tell me where you think that earnings can compound at 25% plus? DMart could be one of them, because the runway for growth is so high. And if they can deploy their cash flows, I mean, they've opened 100 plus stores in the last 2-3 years. And you've not got the best out of those stores yet because of constant shutdowns and whatever. But I think over the next 2 years, you know, you can really see the returns from that investment that has been made. And you know, he can probably go from, he's like 295 stores, Can I envisage a DMart at 500, 600 stores or 750 stores? I think so.
And
So there is a massive growth ahead of you.
RKD has always shared with us that till the time Indians will prefer price over time, he'll be in business.
Yeah.
And I think that's what happens.
Yeah.
But I'm so glad that you found time to join us today. It's been great engaging with you. Great to have
Thank
you
you,
back.
Nit.
And I look
Thank you,
forward to
Nikhil.
much more engagements.
Sure.
Let's get a disclosure going. We've been very stock specific today.
Yes, so all the stocks that I mentioned today on the talk, we and our clients own it, and this was in no manner a recommendation. So please talk to your financial advisor and take all these recommendations with a pinch of salt. They were not recommendations in the first place, and we do own them.
That was the idea to really describe the investment philosophy of Alchemy, and it was so nice to discuss and understand how can you really do a combination of long-term as well as big bets in identification. That's the beauty of what Hiren and his team has managed. Thank you for watching this edition of Market Makers. I'll see you again next week.